right now, the American consumer is sitting on more home equity than at almost any point in history.
Yeah, it's honestly staggering when you look at the charts.
It really is. Like, if you look at the aggregate data, homeowners are incredibly wealthy on paper. They've seen their property values skyrocket by, roughly 50% over the last few years.
Right.
And yet, if you ask them to remodel their kitchen or upgrade their master bathroom, they completely freeze.
It is the defining paradox of the current macroeconomic environment, right? I mean, you have a customer base that is employed, they're generally seeing wage growth, and they're sitting on a mountain of asset wealth.
Yeah, but they can't touch it.
Exactly. They are absolutely paralyzed by the cost of accessing that wealth.
Because accessing it actually means confronting a 7 or maybe 8% interest rate on a home equity line of credit.
Which nobody wants to do right now.
No, of course not. Or, it means giving up that golden handcuff, the 3% mortgage they locked in back in 2021 if they want to move to a new house.
Right, which creates this profoundly stuck, totally frozen housing market.
Exactly. So welcome to this deep dive into Home Depot's Q1 2026 earnings call. Following our Talk Tickers format, our mission today is to cut through the corporate fluff, and break down how the quintessential home improvement giant is actually navigating this weird paradox.
And we're bringing a very data-forward, plain language approach to translate all that Wall Street jargon into actionable insights for you, the retail investor.
Spot on. We're going to look at the raw data, the behavioral shifts, and the long-term strategic maneuvers to figure out what this actually means for your portfolio.
Because looking at Home Depot right now is arguably the best proxy we have for the health of the American middle-class infrastructure.
They really are the bellwether.
Yeah, they are. When housing turnover stalls, meaning, people aren't buying new homes and immediately doing the customary $20,000 in paint, flooring, and landscaping upgrades, well, Home Depot is the first to feel that structural headwind.
So the question we are exploring today is whether this company is merely surviving a brutal macro winter, or if they are quietly rebuilding their entire business engine while no one is looking.
Let's get straight into the scoreboard, right? Section 1?
Yeah, let's do it. We always start with the raw data. The raw numbers for the first quarter show total sales hit $41.8 billion.
Which is a massive number.
It's huge. That's an increase of 4.8%, or roughly $1.9 billion compared to the exact same period last year.
So top-line revenue is growing, which sounds fantastic on a headline banner.
Right, but then you look at the comparable the comps. Total company comps were up just 0.6%.
And U.S. comps specifically?
U.S. comps were up an incredibly modest 0.4%.
Okay, so that spread right there. The spread between the 4.8% total revenue growth and the 0.6% comp growth. That is the entire story of Home Depot's current corporate strategy.
Break that down for the listener. Why does that spread matter so much?
Well, for anyone tracking retail intimately, you know that comps, which only measure stores that have been open for at least 12 months, are the true vital sign of organic demand.
Right, because it strips out the illusion of growth.
Exactly. It filters out the artificial bump you get from just buying up other companies or slapping your logo on 100 new buildings.
So if your comps are flat, the core existing footprint isn't attracting a massive new wave of organic foot traffic.
Precisely. A 0.4% U.S. comp growth means the existing stores are essentially just treading water.
Yeah.
They're fighting tooth and nail just to hold the line against inflation and a general lack of foot traffic.
So the fact that top-line revenue grew by almost $2 billion
is entirely a function of their aggressive acquisition engine, which we definitely need to unpack thoroughly.
We will definitely get into the acquisitions, but I want to stay on the profitability metrics for a second because there is a noticeable compression here that I want to push back on.
Okay, let's hear it.
So adjusted diluted earnings per share came in at $3.43 for the quarter.
Right.
That is actually a step backward from the $3.56 they posted in Q1 of last year. And, I want to be clear about the numbers they provide.
You're talking about the unadjusted versus adjusted EPS.
Yeah. Unadjusted EPS was actually lower at $3.30, but management was very aggressive in steering analysts toward the $3.43 adjusted figure.
Well, to be fair, it is a totally reasonable adjustment in this specific context.
Is it? I mean, 13 cents is a big gap.
It is, but the 13-cent difference between the unadjusted and adjusted EPS comes down entirely to $171 million in pre-tax intangible asset amortization.
Okay, let's translate that Wall Street jargon. That's basically the inevitable accounting hangover of going on a corporate shopping spree, right?
Exactly. When you buy massive B2B distributors, you aren't just acquiring warehouses full of drywall and copper piping.
Right, you're acquiring all the invisible stuff.
Yeah, you're acquiring customer relationship lists, proprietary software, brand equity, and Wall Street accounting rules force you to slowly write down the value of those invisible assets over time.
But that $171 million isn't actual cash walking out the back door of the Atlanta headquarters?
No, not at all. It is purely a paper expense. And in a high interest rate environment where free cash flow is the ultimate kingmaker, management is rightly pointing out that the underlying cash generating power of the business shouldn't be penalized by an accounting quirk.
Okay, I'll accept the adjusted $3.43 EPS, but the profit per share is still shrinking while top line revenue is expanding by nearly 5%.
True.
And that leads us to the margin profile. Gross margin dropped 75 basis points year over year to 33%.
For those newer to the terminology, 75 basis points is just a 0.75% decline.
Right, thank you. And adjusted operating margin sat at 12.3%, which is down from 13.2% last year. So the company is pushing more money through the register, but keeping less of it.
Yeah, that's the reality of the math right now.
If operations are as tight as management claims, why is the profitability naturally eroding like this?
Because they are intentionally altering the DNA of the company.
How so?
The margin compression is largely the mathematical reality of absorbing GMS. That's a major interior building materials distributor they recently acquired.
Ah, right. Because wholesale margins are totally different than retail margins.
Exactly. When you move away from selling a single power drill to a homeowner at like a 40% markup and move towards selling 20 tons of steel framing and drywall to a commercial contractor.
The wholesale dynamic takes over. You are dealing with massive volume, but razor-thin margins.
Spot on. The chief financial officer, Richard McPhail, laid this out really clearly. The vast majority of that 75 basis point drop in gross margin is just the mix shift.
Meaning the blend of businesses changed.
Right. The overall corporate average gets pulled down when you blend a traditional retail operation with a heavy-duty wholesale distribution business. It's a deliberate strategic trade-off.
So they are accepting slightly lower overall margins in exchange for capturing massive locked-in B2B revenue streams.
Exactly. But I don't think we can put the entirety of that margin compression on just the GMS acquisition.
No. What else is dragging it down?
The transcript specifically highlighted deliberate price investments in the roofing market, driven by their specialty distribution arm, SRS.
Oh, right. The roofing market dynamic is critical to understand right now.
It really is. Last year, the industry experienced a catastrophic 28% drop in roofing shipments. I mean, that's the worst single quarter since 2019.
Wow. So in a contracting market like that, distributors usually panic, right? They try to raise prices to protect their margins, which ultimately alienates the customer.
Normally, yes. But instead, Home Depot ordered SRS to hold the line on value pricing.
Wait, really? They just ate the cost?
Yeah, they actively chose to eat the margin compression to defend their market share. Think about it. If you're a roofer trying to survive a brutal macro environment and your distributor refuses to gouge you on shingle prices, you remember that when the market recovers.
Yeah, it's the classic long-term greed versus short-term greed maneuver.
Exactly. They are using their massive fortress-like balance sheet to subsidize price stability for their professional customers.
Which effectively bleeds out their smaller, highly leveraged competitors who simply cannot afford to take the margin hit.
It's ruthless, but it's brilliant.
Okay, so the raw numbers, the flat comps, the EPS dip, the margin compression, all point to a company that is fundamentally transitioning its business model while under intense macroeconomic pressure.
Right.
But the overall quarterly numbers actually mask how volatile the day-to-day retail environment is right now. Let's look at the monthly comp cadence they released.
The monthly breakdown is wild.
It really is. February was up 0.7%. March accelerated to a really solid 2.0% positive comp.
Looking good so far.
Yeah, but then April fell off a cliff into negative territory, down 0.5%. What causes a multi-billion-dollar retail engine to stall that aggressively in a 30-day window?
Well, to understand that, we have to move into section 2. The story behind the numbers. You have to look at the psychology of the consumer right now.
Right. Management kept using this specific term on the call. They said the consumer is stuck.
Yes, they aren't broke. The underlying demand is actually remarkably consistent with what we saw in fiscal 2025.
But they are operating with this overwhelming sense of financial hesitation.
Exactly. And you see this hesitation explicitly in the transaction data. Comparable average ticket, which is just the amount of money spent per checkout, increased by 2.2%.
But the actual number of transactions, the sheer volume of people walking through the doors and swiping a card, decreased by 1.3%.
Right. Now, inflation is certainly propping up that average ticket size to some degree. Things just cost more.
But the real story is what they are not buying, right?
Absolutely. Big ticket discretionary items, basically anything over $1,000, are acting as the primary drag on the entire operation.
This makes perfect logical sense when you think about the HELOC trap we discussed in the intro.
Yeah, explain how that looks for the average shopper.
Well, if I walk into Home Depot on a Saturday, I have zero problem spending $150 on a Ryobi battery trimmer, or like $80 on a couple of gallons of premium Behr paint.
Right, that easily fits into your monthly cash flow. You feel wealthy enough to maintain your property.
Exactly. But the moment you start pricing out a $25,000 kitchen remodel with custom cabinets, quartz countertops, new appliances,
you're suddenly forced to look at financing.
Yeah. You are forced to look at a 7% interest rate to borrow against the equity in your home. And the consumer simply shuts the laptop and decides to leave with their old oak cabinets for another year.
The large cross-category discretionary project is basically dead in the water right now.
Which explains the broader malaise perfectly, but it still doesn't fully explain that April cliff dive.
No, it doesn't.
If the consumer is universally stuck, why was March up 2% while April was negative?
Because Home Depot, despite all its technological advancements, is still fundamentally tethered to the weather.
The bathtub effect.
Yes, the executives call it the bathtub effect. Look, in the retail sector, spring is the make or break season. It is their holiday quarter.
Right.
And in February and March, the West and the South experience incredibly favorable early spring weather.
Right. The sun comes out, people get cabin fever, and they immediately drive to the garden center to buy mulch, fertilizer, patio furniture.
Exactly. It pulled a massive amount of seasonal demand forward into March.
Okay, so what happened in April?
Well, the last 2 weeks of April hit, bringing heavy, persistent freezing rain across the entire northern United States.
Ouch.
And the timing of that rain is critical. If it rains on a Tuesday, a contractor might just work inside. But if it rains heavily on a Saturday in late April, that weekend DIY retail sale is completely destroyed.
Because you cannot recover a lost spring Saturday. You definitely aren't loading 20 bags of topsoil into your SUV in a torrential downpour.
No, you're staying on the couch.
But the bathtub effect implies that the water eventually levels out, right? Like if I didn't buy the lawnmower in April, the grass doesn't magically stop growing. I eventually have to buy it.
And that is exactly what the data showed. When May arrived and the weather patterns normalized across those northern markets, customer engagement and transaction volume immediately bounced back to the strong levels they saw in February and March.
So the demand wasn't destroyed by the economy, it was just delayed by the atmosphere.
Exactly, which is a highly encouraging signal for anyone holding the stock right now. It proves the baseline demand is sticky.
Now, despite this big ticket freeze and the April weather shock, 9 of their 16 merchandising departments still posted positive comps. Over half the store is growing.
Which is honestly impressive.
The absolute stars of the quarter were portable power and outdoor power equipment. In fact, they set a Q1 sales record in those categories.
Which is staggering in a down market. To set an all-time sales record when your core consumer is supposedly paralyzed speaks to a massive technological shift occurring in the aisles.
It's the battery revolution, right?
It absolutely is.
You look at their lineup, Ryobi, Milwaukee, DeWalt, Makita. The innovation in cordless tools has reached a tipping point.
Yeah, 5 years ago, a battery-powered lawnmower or chainsaw was considered like a novelty for a homeowner with a tiny suburban patch of grass.
Right, it was practically a toy.
Exactly. But today, the torque and battery life are legitimately replacing gas-powered equipment for heavy-duty work.
And the brilliant part of this merchandising strategy is the lock-in effect of the battery platforms.
Oh, it's so sticky.
Once a consumer buys a Milwaukee drill and has 3 of those specific M18 batteries sitting in their garage, they are practically married to the Milwaukee ecosystem.
Yep. When they need a circular saw, a leaf blower, or a work light later on, they are buying the Behr tool from Milwaukee because they already own the expensive part, the power source.
It transforms a one-time hardware purchase into a recurring revenue stream.
Which is retail gold.
But what fascinates me is the dichotomy of the brands driving these records. Like, Ryobi is the undisputed king of the DIY weekend warrior, right? It's bright green, highly affordable, perfect for light yard work.
Well,
But Milwaukee and DeWalt are heavy-duty, expensive, professional-grade platforms. The fact that all of them are flying off the shelves reveals a massive divergence in their customer base.
it proves that the pro customer is currently the undisputed engine of Home Depot's resilience. Management made it abundantly clear on the call. Pro sales significantly outpaced DIY sales in the first quarter.
Let's unpack that because it seems kind of counterintuitive on the surface. If homeowners are terrified of funding large discretionary remodels, why are professional contractors buying so much equipment and material? Who are they working for?
They are working on the unavoidable projects, the repair, replace, and maintain category.
I see.
You might put off the luxury kitchen remodel, but if your pipes burst, your roof leaks, or your HVAC system dies in July, you are calling a pro.
Yeah, you don't really have a choice there.
Exactly. And Home Depot recognizes that while the DIYer is discretionary and flaky, the pro is consistent, high volume, and essential.
So they are actively shifting the entire weight of the corporation to capture and lock in that professional contractor.
Yes. And you can see this shift in the digital infrastructure they are deploying.
Yeah, talk about that, because for decades, Home Depot was basically just a physical warehouse you walked into.
Not anymore. Senior Executive VP Anne-Marie Campbell spent a lot of time detailing the rollout of massive digital workspaces built exclusively for the pro.
They are essentially becoming a B2B software as a service company disguised as a hardware store.
That's a great way to put it. The digital portal they built is designed to eliminate the most expensive commodity a contractor has, which is administrative friction.
Right.
They have introduced an AI-powered material list builder that is genuinely changing the workflow of local contractors.
Let's dig into the mechanics of that because, AI is the ultimate buzzword right now, and a lot of it is just smoke and mirrors. How does an AI tool actually help a guy building a deck or framing a house?
In this context, it is a highly practical workflow integrated tool.
Okay, give me an example.
Imagine a contractor who just won a bid to frame a small residential addition. Historically, he would sit in his truck at 6 p.m., exhausted, staring at architectural notes.
Yeah, the classic clipboard warrior.
Right, and he's manually typing out hundreds of specific CUs into a clunky website, calculating exactly how many 2x4s, boxes of specialized screws, rolls of insulation, and sheets of OSB he needs.
Which takes hours.
Hours. And the margin for error is high.
And if he forgets the specialized fasteners, the crew basically stands around doing nothing the next day, bleeding his profit margin.
Exactly. Now, with the AI material list builder, the contractor can input unstructured data, like a rough text list or a standardized project scope, and the AI instantly translates it into exact Home Depot SKUs.
It's wild.
It checks localized inventory across the nearest 3 stores, flags any back-ordered items, recommends equivalent substitutes, and packages the entire order for a single-click purchase.
So it turns 2 hours of administrative agony into a 3-minute automated process.
Exactly.
Once you give a business owner a tool that gives them 2 hours of their evening back, you have earned their loyalty forever. They are never going back to a manual clipboard at the local lumber yard.
Never. And the digital workspace goes far beyond just ordering. It's becoming a full logistical command center.
Yeah, they're leaning heavily into complex delivery scheduling, utilizing what they call ship from best location logic.
This is where their sheer scale becomes a weapon.
Because if a contractor orders a massive load of lumber, drywall, and custom windows, it doesn't all have to come from the store 3 miles down the road.
Right. The algorithm dynamically assesses the entire regional network. Store A might have the lumber, but Store B has the flatbed truck available, and the regional fulfillment center has the custom windows.
So it pieces it all together.
Exactly. The system automatically orchestrates the logistics to ensure everything arrives at the job site simultaneously inside an incredibly narrow delivery window specified by the contractor.
Because in construction, staging is everything.
Oh, absolutely.
You cannot drop a pallet of drywall on a muddy job site 3 days before the roof is finished. It'll be ruined. You need the materials exactly when the crew is ready to install them.
And Home Depot is offering Amazon-level logistical precision to guys driving pickup trucks.
And to sweeten the deal further, they are deploying the most powerful weapon in B2B sales, which is aggressive trade credit.
Yes, the working capital game.
For the listener who might not understand the cash flow nightmare of running a contracting business, explain why Home Depot expanding their trade credit to offer 30-day payment terms on shipment is such a massive competitive moat.
Cash flow is the absolute lifeblood and honestly often the silent killer of a small contracting firm.
Yeah, it's brutal.
A pro typically receives a partial deposit from a homeowner to start a job, but they have to buy all the materials up front. They don't get the next major payout from the client until certain milestones are passed, like the framing is done or the rough plumbing passes inspection.
And that can take weeks.
Weeks. So for those weeks, the contractor is entirely out of pocket. Their cash is literally tied up in the wood and pipes sitting on the job site.
Right. If they buy from a local, independent, mom-and-pop supply house, they usually have to pay cash on delivery.
Precisely. But Home Depot is stepping in and saying, hey, we will give you the materials today, and you don't owe us a dime for 30 days after we ship it.
Wow.
Home Depot is leveraging its massive corporate balance sheet to act as a short-term, zero-interest bank for the contractor.
It completely bridges the cash flow gap. The contractor finishes the milestone, gets paid by the homeowner, and then pays Home Depot.
Yep, it completely removes the financial anxiety of taking on larger jobs.
If I'm a pro, I am routing every single purchase I make through that credit facility.
And management explicitly noted that this 30-day term is driving massive adoption in longer lead time, high-ticket categories like custom windows, doors, and appliances.
Because they're basically financing the most expensive parts of the build.
Exactly.
All of these tactics, the AI tools, the logistical routing, the bankrolling of working capital, they all feed into the central thesis of CEO Ted Decker's strategy.
Which is the TAM expansion.
Right. For decades, Home Depot defined its total addressable market, its TAM, as a $700 billion pie. That included the massive DIY base and the traditional store shopping pro.
But on this call, Decker is officially steering the ship toward a $1.2 trillion TAM.
That $500 billion expansion is arguably the most important structural shift in the company's history.
It really is. They are aggressively stepping outside the four walls of the orange box and plunging into the highly fragmented, highly lucrative world of complex B2B distribution.
And they aren't doing it organically. They're buying their way in. The acquisition engine is running red hot.
It's very hot. We already mentioned SRS, which overnight made Home Depot a dominant force in professional roofing, pool, and landscape supply distribution.
And we mentioned GMS, which handles the massive heavy-duty interior materials like commercial drywall and steel studs that you simply can't sell effectively out of a retail storefront.
And the capstone announcement of this quarter was the finalized acquisition of Mingledorse.
Right, Mingledorse.
Wow.
Which is a massive wholesale distributor of HVAC equipment with 42 locations spread across the southeastern United States.
Now, this is where we really need to connect the dots on market insulation.
Yeah, please do. Why on earth is a retail store so obsessed with buying up wholesale roofing and HVAC distributors right now?
Because it is the ultimate hedge against a high interest rate environment.
Okay, walk us through that.
We established that discretionary remodels are dead, but HVAC, roofing, and plumbing, those are not discretionary. They are the definition of inelastic demand.
If you live in Georgia and your central air conditioning unit spectacularly fails in the middle of a 100-degree July heat wave, you are not checking the Federal Reserve's dot plot to see where interest rates are going.
No, you're not.
You are picking up the phone and you are taking out a loan if you have to. You are replacing that unit immediately.
Exactly. The same goes for a roof that starts leaking into your living room after a spring storm. By acquiring these specific B2B distributors, Home Depot is buying revenue streams that are entirely divorced from consumer confidence.
They are mandatory, emergency-driven, or essential maintenance expenditures.
Right. And the Mingledorse acquisition specifically offers a fascinating strategic angle regarding HVAC parts.
Yeah, Ted Decker made a point to highlight that on the call. While selling massive whole-house AC units is great, those often come with strict regional exclusivity deals from the manufacturer.
Right, like you can't just sell a Carrier unit everywhere.
Exactly, but the parts, the capacitors, the blower motors, the specialized relays, those are universal.
And the margins on replacement parts are astronomically higher than the margins on whole units.
Furthermore, they want to take that parts distribution national. A typical HVAC repair tech spends half their day driving across the city to a specialized supply warehouse just to pick up a $40 relay switch.
It's terribly inefficient.
So Home Depot wants to use Mingledorf's supply chain expertise to stock those highly specialized parts inside their 2,300 retail locations.
Think about the logistical dominance of that. You are turning every single Home Depot store into a forward operating base for specialized B2B distribution.
Right. The repair tech doesn't have to drive 40 miles in traffic to the Mingledorse warehouse. They drive 4 miles to local Home Depot, grab the part, and get back to the job site.
It increases the tech's billable hours and captures a high-margin sale for Home Depot. It's a win-win.
But this introduces a massive operational collision, doesn't it? You cannot simply slam a high-speed, demanding B2B distribution model on top of a traditional consumer-facing retail store without causing absolute chaos in the aisles.
Which is exactly why Anne Marie Campbell spent so much time discussing the radical operational restructuring happening on the store floor right now.
They are fundamentally changing what it means to wear an orange apron.
Yes. Historically, the Home Depot associate role was a pretty chaotic blend of duties.
Yeah, you were expected to be a smiling, knowledgeable salesperson helping a homeowner pick out bathroom tile.
But you were also responsible for grueling logistical tasking.
Break down tasking for us.
Tasking is the invisible labor of retail. It's unloading pallets, auditing inventory counts, building promotional end caps, climbing up and down ladders to pull down overstock, and updating thousands of price tags.
And it creates massive friction for the customer. We've all experienced this, right?
Oh, constantly.
You are wandering the plumbing aisle trying to figure out which PVC fitting you need to fix a sink. And the only employee in sight is 20 feet up a rolling staircase, laser scanning boxes, completely engrossed in inventory management.
Yeah, they're torn between finishing their corporate mandated task and actually helping you.
So Home Depot recognized that this blended role was destroying their customer service metrics and slowing down their supply chain efficiency.
So they're executing a hard fork in their labor model.
Yes, they are transitioning all in-store tasking to a dedicated, specialized unit called the Merchandise Execution Team, or MET.
So the MET team handles the boxes, the shelves, and the pallets. They were the logistical backbone.
Exactly. By stripping the logistical burden away from the traditional store associate, it completely frees up the orange apron to do one thing: aggressively engage with the customer and drive complex sales.
And they've rolled this labor split out to over 1,000 stores already, right?
Yeah, and they are targeting a full system-wide transition by the end of fiscal 2026. If I'm an investor, this is exactly what I want to see. You are optimizing the physical asset.
And the internal data is already validating the move. They are seeing significantly higher productivity from the dedicated tasking teams because they aren't constantly interrupted, and massive spikes in customer engagement and satisfaction scores on the sales floor.
This restructuring is brilliant, but it leads me back to a fundamental concern. Let's synthesize all of this.
Okay.
We have MET teams hyper-focused on efficiency. We have billions spent on acquiring wholesale roofing and HVAC distributors. We have AI tools routing massive orders to job sites.
Right.
It feels like the entire corporation is pivoting away from the everyday homeowner. If the average consumer is stuck buying $150 drills and refusing to do $15,000 remodels, is Home Depot simply abandoning the DIYer to become a pure B2B machine?
I wouldn't say they're abandoning the DIY. I mean, the retail footprint is still a $100 billion cash register.
True.
But they are aggressively realistic about where the growth ceiling is right now. The DIY market is saturated and highly sensitive to interest rates.
Whereas the pro market
is fragmented, wildly inefficient, and deeply lucrative. They are focusing their capital where the leverage is highest.
And you can see how ruthlessly they are targeting the pro, even down to the individual brand exclusivity deals they are signing.
Oh, the Ramboard deal.
Yes. Billy Bastek, the head of merchandising, announced on the call that they secured an exclusive retail deal with Ramboard.
For anyone outside the construction industry, Ramboard might sound trivial, but it is a massive strategic acquisition.
It really is. It's an ultra heavy-duty engineered cardboard that contractors roll out to protect finished hardwood floors during a major construction project.
It has been the absolute industry standard for over 2 decades.
If you walk onto a high-end job site, the floors are covered in Ramboard. By locking up exclusive retail rights, Home Depot is essentially creating a mandatory toll booth for contractors.
Yep. If a pro needs to protect the floors, which is a non-negotiable requirement on any professional job, they have to distinctly drive to a Home Depot. or order through their digital portal.
And once that contractor is in the ecosystem to buy Ramboard, the cross-selling algorithm takes over.
Right. Oh, you bought Ramboard. Do you also need painter's tape, contractor bags, heavy-duty fasteners, and a new M18 battery?
Exactly. They are using these highly specific essential items as a gravitational pull to capture the entire project spend.
And management explicitly stated they're targeting a $400 million cross-sell run rate this year, just between the core retail stores and the newly acquired SRS and GMS branches.
That's huge.
They're actively training their sales teams to spot a roofer buying shingles from an SRS branch and seamlessly pitch them on buying their ladders, nail guns, and safety equipment from the Home Depot retail side.
They are building an inescapable, fully enclosed ecosystem. A contractor literally never has to give a dime to a competitor.
Which brings us perfectly to Section 3, the forward-looking expectations. Guidance.
Yes. We have dissected the stagnant Q1 numbers, the frozen consumer psychology, and the massive B2B infrastructure build-out. So what exactly is management promising Wall Street for the rest of fiscal 2026? How long are they projecting this macro winter will last?
The overarching theme of their guidance is stubborn confidence.
Stubborn confidence. I like that.
Despite the negative April comp, despite the sticky inflation data we're seeing in the broader economy, and despite the Federal Reserve holding interest rates higher for longer, Home Depot management is holding the line.
They reaffirmed their previous 2026 guidance without a single downgrade.
Yep. Let's lay out the specific mathematical promises they made. They are projecting comparable sales to range between flat and positive 2% for the full year.
In the context of a 30-year low in existing home sales, promising that your core stores will not shrink is viewed by institutional investors as a sign of massive operational strength.
Absolutely. But then you look at the total sales growth projection, which they expect to land between 2.5% and 4.5%.
That is a highly visible gap.
And that gap is the mathematical footprint of the total addressable market expansion.
Right. The difference between the flat comps and the 4.5% total growth is entirely the injected revenue from SRS, GMS, and Mingledorse.
They essentially bought that growth to mask the stagnation of the core retail environment.
Moving down to profitability, they are projecting an operating margin between 12.4% and 12.6%.
And adjusted earnings per share is modeled to increase anywhere from flat to 4% compared to fiscal 2025.
It is a model of steady, heavily defended, modest growth. They are projecting stability in an incredibly unstable housing market.
They also outline their capital allocation strategy, which is telling.
Yeah, capital expenditures, the money they are physically plowing back into the business for new stores, supply chain logistics, and AI tech will remain steady at roughly 2.5% of sales.
And the physical footprint expansion tells the entire TAM story. They plan to open just 12 to 15 traditional retail stores this year, compared to 40 to 50 new SRS wholesale distribution locations.
They're building out the wholesale network at 3 times the speed of the retail network. The pivot is undeniable.
It really is. However, I have to throw a massive red flag on the play regarding how they actually plan to achieve this flat to positive comp growth.
Okay, let's hear the red flag.
During the analyst Q&A session, they were pressed hard on the mechanics of their back half projection. The consumer is stuck. Big ticket projects are dead, so where is the second half growth actually coming from?
And management gave an answer that borders on alarming.
The meteorological modeling caveat.
Exactly. Management explicitly stated they expect higher comparable sales in the second half of the year, but they forcefully clarified that this is not based on any assumption of macroeconomic relief.
Right. They are not modeling for a massive interest rate cut. They're not modeling for a sudden thaw in the housing market.
They're basing their entire second half growth projection on a return to normal, severe weather patterns.
Normal, severe weather. That is a beautifully sanitized corporate phrase.
It really is. What they are actually saying is that Q2 and Q3 of last year experienced historically low levels of destructive hail and hurricane activity.
Right, because there were fewer catastrophic storms, fewer roofs were ripped off, and fewer basements flooded.
Therefore, they sold far less plywood, generators, pumps, and shingles than they normally do.
Which artificially deflated the baseline numbers for last year.
Right. So management is telling Wall Street, hey, we will show growth in the second half of this year because we are mathematically assuming that weather will return to its historical average of destroying property, forcing people to come to our stores to buy repair materials.
It's a bold thing to say out loud.
It is. Building an investment thesis on the assumption of localized natural disasters feels incredibly fragile. What if the Atlantic hurricane season is mild again? Does the entire growth model for the back half of the year instantly collapse?
It is a completely valid concern, but you have to view it through the lens of statistical modeling rather than gambling.
Fair enough.
A company the size of Home Depot has decades of granular, highly localized weather data. They know exactly how much a Category 2 hurricane striking the Florida Panhandle generates in specific SKU sales.
They know exactly how a severe hailstorm in Texas impacts roofing material demand.
Exactly. So they bake a certain baseline of catastrophe into their annual revenue run rate.
So they aren't hoping for disaster. They are just recognizing that last year's lack of storms was a statistical anomaly.
Right. When they guide for growth based on weather, they are just predicting a regression to the mean. If the weather behaves the way it has averaged over the last 50 years, their numbers will automatically look better than the artificially quiet period they are comparing against.
It still highlights a vulnerability, though. But to your point, management emphasized that they cannot control the jet stream and they cannot control the Federal Reserve.
No, they can't. They are hyper-focused on controlling the controllable.
And the ultimate metric for controlling the controllable in retail is inventory management.
Oh, absolutely. A bloated inventory in a high interest rate environment is a death sentence.
It ties up cash and leads to massive margin-crushing clearance sales. But Home Depot reported their inventory turns ended the quarter at 4.2 times.
Meaning they successfully sold through their entire multi-billion-dollar stockpile of inventory 4.2 times over the course of the trailing 12 months.
That is a highly tuned, incredibly efficient supply chain. They are not sitting on mountains of dead stock.
They are matching their purchasing algorithms perfectly to the muted reality of the stuck consumer.
They are also aggressively managing supply chain costs, negotiating with vendors, and systematically filing for tariff refunds to protect their margins from international trade friction.
They are executing the unglamorous fundamentals of retail flawlessly while they build out the B2B empire in the background.
Which brings us to the ultimate payoff, Section 4. We have looked at the scoreboard, dissected the psychology of the frozen housing market, explored the massive pivot toward B2B wholesale integration, and scrutinized the storm-dependent guidance.
Now we synthesize it all.
Yes. If you are sitting there listening, what is the actual actionable takeaway regarding Home Depot stock right now?
Looking at the entire diagnostic landscape, our Talk Ticker's verdict on Home Depot is a very firm, cautiously bullish hold signal.
Let's break that down, starting with the caution. Why are we telling people not to aggressively back up the truck and buy every share they can find?
Because the short-term reality of the macroeconomic environment is a heavy, suffocating blanket on the core business.
Right.
If you are an investor looking for a high beta stock that is going to rocket up 30% in the next 2 quarters based on an explosive surge in consumer spending, Home Depot is absolutely the wrong play.
The structural headwinds are simply too strong. The housing market turnover is functionally paralyzed.
The cost of financing a $20,000 renovation through a HELOC is historically prohibitive.
The typical middle-class homeowner is entirely focused on maintenance and entirely avoiding transformation. You cannot force organic retail growth when your customer is mathematically locked out of big-ticket spending.
Exactly. The short-term upside is heavily capped by the Federal Reserve's interest rate policy.
But that leads us directly to the bullish case, which requires a multi-year time horizon.
Yes, you have to zoom out.
If you stretch the timeline out, Home Depot is operating less like a traditional retailer and more like an impenetrable fortress.
The bull case rests entirely on their strategic pivot. They looked at the frozen DIY consumer and didn't panic.
Instead, they weaponized their balance sheet to aggressively acquire SRS, GMS, and Mingledorse.
They're systematically expanding their total addressable market from $700 billion to $1.2 trillion by attacking the highly fragmented, highly resilient B2B wholesale distribution sector.
It is a brilliant Trojan horse strategy. To the casual observer driving past, it looks like the same orange big box store selling plants and paint.
But behind the scenes, they're using the cash flow from that retail store to subsidize the creation of a massive nationwide B2B supply chain network.
They're deploying AI tools to eliminate administrative friction for contractors.
They're offering 30-day trade credit to act as a localized bank.
They are locking in the most lucrative, inelastic demand in the economy.
So practically speaking, if you currently hold the stock in your portfolio, the play is to sit back, reinvest, and collect the yield.
Home Depot is a phenomenal cash-generating machine that prioritizes shareholder return. They paid out $2.3 billion in dividends this quarter alone.
They are quite literally paying you to wait out the macro storm.
And if you don't own the stock and are considering initiating a position, view this as a premier defensive play that is quietly coiling a massive spring. I look at Home Depot right now like a high-performance race car that is currently trapped in massive, gridlocked traffic.
The traffic being the 7% mortgage rates and the frozen housing market.
Exactly. The car literally cannot go 200 miles per hour right now. It is impossible. But management isn't just sitting in the driver's seat complaining about the traffic.
Right.
While the car is idling, the pit crew is actively upgrading the entire machine. They are swapping in a bigger turbocharger by acquiring SRS.
They are putting on better tires by expanding trade credit.
They are upgrading the navigation system with the AI material list builder. They are building a fundamentally superior, higher capacity machine.
And the moment the traffic clears,
the moment interest rates eventually drop, the lock-in effect breaks, and housing turnover unfreezes, this newly upgraded engine is going to absolutely dominate the landscape.
it is the perfect framing. They are ensuring that when the market inevitably turns, they capture a significantly larger percentage of the B2B and B2C spend than they did in the last cycle.
And that wraps up our deep dive into the underlying mechanics of Home Depot's strategy. But before we sign off, we always want to leave you with a final provocative thought to mull over on your own.
Something we haven't explicitly concluded, but that the data heavily implies.
Exactly. And today, that thought centers on the long-term unintended casualties of this $1.2 trillion TAM expansion.
We have spent the last hour praising Home Depot's aggressive capture of the pro market and their seamless integration of retail and B2B wholesale distribution.
We talked about how incredible the AI routing and the 30-day credit terms are for the contractor.
But consider the other side of that transaction. What happens to the independent local supply houses over the next 5 to 10 years?
The regional lumber yards, the family-owned plumbing supply counters, the independent roofing distributors who have been the backbone of local construction for decades.
Right. As Home Depot integrates AI that perfectly predicts a contractor's material needs.
As they roll out zero-interest 30-day float with the click of a button.
As they leverage their massive national footprint to deliver materials from an optimized web of stores and flatbeds. How can a local mom-and-pop supplier possibly survive?
They don't have the balance sheet to offer that kind of credit. They don't have the tech budget to build an AI app.
Are we currently witnessing the slow, methodical, and inevitable extinction of the regional B2B home improvement distributor?
It's a fascinating, slightly terrifying question about the future landscape of American business consolidation.
It is the ultimate collision of localized relationships versus relentless tech-enabled scale. It is a storyline that will define the next decade of this industry.
We will certainly be tracking the data to see how it plays out. Thank you for joining us on this deep dive. Our singular goal is to make sure you walk away as the most well-informed, structurally literate person in the room regarding the financial realities of the companies you care about.
The macroeconomic landscape might be incredibly murky right now, but if you look past the headlines and dig into the operational mechanics, the underlying blueprint of Home Depot is incredibly clear.
Until next time, keep digging into the numbers.